Picture two coworkers at the same company, same job title, same starting salary of $48,000, same annual raises over their careers. The only difference between them is 10 years. The first, we'll call her Elena, started investing $300 a month into an index fund the day she turned 25. The second, David, started investing the exact same $300 a month, but he waited until he turned 35. He spent that decade telling himself he'd start once he made more money, once the timing felt right, once the market calmed down. Both of them increased their contributions identically as their salaries grew. Both of them retired at 65. Both of them earned an average 8% annual return over their investing lifetimes. At 65, Elena's account held $1.47 million. David's held $642,000. Same contribution amount, same raises, same returns, same discipline for the entirety of their investing lives. The only variable was 10 years, and that single variable cost David more than $800,000. Not because he did anything wrong once he started, not because he chose worse investments. Because those 10 years, ages 25 to 35, were the 10 years his money would have compounded the longest. And once they were gone, no amount of catching up could ever buy them back. This is the part about investing that almost nobody explains clearly, and it's the reason most people's retirement accounts look nothing like the number they actually need. It isn't about picking the right stock. It isn't about timing the market correctly. It's about a handful of quiet decisions, made early or made late, made consistently or made emotionally, that determine almost the entire outcome before most people even realize the race has started. Today, I want to walk through exactly what separates people who build real investment wealth from people who invest for decades and still end up with far less than they should have, using the exact same tools available to everyone. Let's start with the math that makes David's story so painful, because once you understand it, you'll never look at "I'll start next year" the same way again. A dollar invested at age 25, earning 8% annually, has 40 years to compound before age 65. That dollar becomes roughly $21.70. A dollar invested at age 35 has 30 years to compound. It becomes roughly $10.10. The exact same dollar invested just 10 years later is worth less than half as much by the time retirement arrives. This is not a rounding error. This is the single most important fact in personal investing, and it explains why the gap between early starters and late starters is almost never something later contributions can close. Fidelity's research on retirement savers consistently shows the same pattern playing out at scale. Investors who begin contributing in their 20s accumulate dramatically more by retirement than investors who begin in their 30s, even when the later group contributes more money in total. The early investor's advantage isn't how much money they put in. It's how long that money had to work before they needed it. Here's the number that should unsettle you if you're not currently investing. According to Vanguard's 2025 How America Saves report, the median 401k balance for Americans aged 55 to 64 sits at just under $88,000. Not the average, which gets skewed upward by a small number of very large accounts, but the median, the number that represents the actual middle of the pack. For someone approaching retirement, $88,000 generates roughly $3,500 to $4,000 a year in sustainable retirement income. Combined with Social Security, that's a retirement built on financial anxiety, not financial freedom. This isn't happening because these people didn't have access to investment accounts. 401k plans have existed since 1978. IRAs have existed since 1974. The information required to invest successfully has been freely available for decades. The gap exists because of a small number of behavioral decisions, repeated or avoided, year after year, that compound just as powerfully as the money itself. The first decision is simply starting, and starting immediately rather than waiting for ideal conditions. Every generation of investors has a reason to wait. In the 1970s, it was inflation and an oil crisis. In 2000, it was the dot-com crash. In 2008, it was the financial crisis. In 2020, it was a pandemic. In 2022, it was rising interest rates. There has never been a year in modern market history that felt like the obviously correct time to start investing, and there never will be. The market has still returned an average of roughly 10% annually before inflation over the past century. Through 2 world wars, a Great Depression, multiple recessions, and countless crises that felt, at the time, like reasons to wait. People who wait for certainty before investing are waiting for something that has never existed and will never arrive. The cost of that waiting isn't measured in missed opportunities. It's measured in the compounding years that can never be recovered, exactly like the 10 years that separated Elena and David. The second decision is consistency through downturns. And this is where most investors actually lose the majority of their long-term returns. Not through bad investment choices, but through panic during declines. Dalbar, a research firm that has tracked investor behavior for decades, has repeatedly found that the average equity fund investor earns significantly less than the funds they're invested in actually return. The funds themselves perform reasonably well. The investors underperform their own funds because they sell during downturns and buy back in after recoveries have already happened, converting temporary paper losses into permanent, realized ones. Consider what happened to two hypothetical investors during 2008. Both had $100,000 invested. The market fell nearly 37% that year. The first investor panicked in November, sold everything, and moved to cash, telling herself she'd get back in once things stabilized. She didn't fully reinvest until 2011, missing the sharpest part of the recovery. The second investor did nothing. He didn't check his account for 8 months. By 2013, the first investor's money had grown to roughly $135,000. The second investor's money had grown to roughly $215,000. Same starting point, same crisis, same eventual recovery in the broader market. The only difference was one decision, made under emotional pressure, at exactly the wrong moment. This pattern repeats in every downturn, because downturns are precisely when panic feels most justified, and precisely when selling does the most permanent damage. The investors who build real wealth aren't the ones who correctly predict when to get out and back in. Almost nobody does that successfully over a full career. They're the ones who never got out in the first place. The third decision is fees, and this is the quietest wealth destroyer in the entire investing world because it never shows up as a single painful moment. It just erodes silently, year after year, disguised as a small percentage most people never bother to check. A 1% difference in annual fees sounds trivial. On a $500,000 portfolio held for 25 years, the difference between a 0.1% index fund fee and a 1.1% actively managed fund fee is not a rounding error. It's approximately $250,000 in lost returns over that period, money that didn't disappear through bad luck or bad markets. It went to fund managers and financial institutions, quietly, every single year, regardless of how the investments actually performed. Vanguard's own research on cost and returns has found no reliable evidence that higher-fee actively managed funds outperform low-cost index funds over long-time horizons, after fees are accounted for. Vanguard's own research on cost and returns has found no reliable evidence that higher-fee actively managed funds outperform low-cost index funds over long-time horizons, after fees are accounted for. Investors paying premium fees are, in the vast majority of cases, paying more for a worse outcome. Long-term investing rewards patience, consistency, early action, and low costs. Small financial decisions, repeated for decades, create extraordinary wealth.